Welcome to my morning chat, 11 o'clock on every Friday. And today I have Ben Jacobs. He's a regional vice president of Primerica Financial Services. And today we wanted to talk about alternative lending and how we qualify on my end as a mortgage broker, how Ben reviews people's files and their financials on his end. So Ben, thank you so much for joining me. How's it going?
Oh, it's going well. Thank you for having me. This is exciting. It's my first live, and we've been doing a lot of these lately. And you and I were chatting a couple of weeks ago about our views on this subject, and I think a lot of advisors and real estate investors, and they think we're on opposite ends. And you and I very much disagree with that. So we thought it was a good timing right now to be chatting about this. So I'm excited to have this chat today.
Yeah, for sure. I mean, you're also a lender and an investor yourself, so that's perfect combination for me because you do understand my end of things. So, how do you want to get started here? Like, do you want me to go through how I look at a client, and then how I shift them over to a financial services consultant like yourself?
Yeah, we can start from the top in terms of both of our processes and how they're very, very much alike in terms of assessing a client's, risk tolerance, or, just how we look at their overall financial situation before we make any sort of recommendation. Because I think that process is very similar for both of us. And when we're talking about when someone wants to invest, it's, investments is a very broad term, right? And we can cover a lot of different asset classes. Some of those are the ones that I put in place for clients, and some of them are the things that you do, right? And so I think just giving people a broader understanding of how we both look at it and how we can actually work together, I think would be a great start.
Yeah, for sure. And I mean, first and foremost, when a client comes to me and they're asking me about private lending and wanting to lend their money, and in my business, we call that being the banker. So essentially, you're developing your own policies and guidelines internally for yourself as to how you're going to lend your money. And let's say they come to me with $200,000, they've got cash, and I do go through the process of a KYI, know your investor. But first and foremost, I always ask them, have you spoken to your financial advisor, your financial consultant? Because risk tolerance and your criteria is very different. And you actually carve out or help them to carve out that piece that they can lend on my half. So you want to go through that process right now, Ben?
Yeah. So like you, if someone comes and just says, look, I want to start investing. So usually for us, just like you, it starts with, we call it a KYC. So that's a know your client. Almost the same thing as what you're talking about, right? Yeah. And that really the whole purpose of that is to get a sense of the person's financial position, get a sense for all of their assets. And, on my end, that really looks at, what phase of investing they're in, and that, are they in the capital accumulation stage, or are they more in the capital preservation stage, right? Those are the main two phases of wealth building, right? And that's kind of what both you and I are talking about and helping clients do, is build wealth. And there's multiple ways we can do that. And there's this, the phases of wealth accumulation, they're not black and white, right? It's not like, oh, if you're below 30, you're only accumulation, and if you're past 50, you're only preservation, because really that's not necessarily the case. Because there are some investors, I know I have some investors in their 60s, but they very much identify as more aggressive investors, even though by traditional standards, you would think they're more capital preservation. They're not. So it really just comes down to figuring out how to identify someone's risk tolerance and their ability to handle market volatility, right? So that's volatility, same thing for you in real estate as well as in financial markets, is just the fluctuations in value, right? So looking for how they can handle potential declines in asset value. So for me, that usually starts with a financial needs analysis, and that takes into account again, like we said, what phase they're in, taking a look at all their assets, and then more importantly, taking a look at all their debt. Because as you know, I know you sell debt in a certain way, but mortgage debt is really not the same thing as consumer debt. But having consumer debt is probably the number one reason why people don't accumulate wealth. Right, is because any rate of return they're getting in their investments is being eroded by not only inflation, but also by the debt interest rate that they're paying, right? So that's really where it starts for me. I don't know if you have something different, or how you're going to take people through your kind of initial process?
Yeah, I usually have a 20-minute conversation with the lenders, potential lender. I always talk about diversification, and obviously I make sure that they speak to a financial consultant so that we are diversifying and we look at their needs analysis. And I talk to them about creating their own internal policy, as I mentioned earlier, and that's based on what geographical location they would be interested in. And this is all to mitigate risk in their investment.
Right.
So for instance, the geographical area, do you want to go to Sudbury versus Toronto? So create your own internal, right? Like create your own internal risk tolerance policy. What loan to value do you want to go to? So typically speaking, a first mortgage, well, all a first and second mortgage combined, you don't want to be over, say, 80% loan to value. So for those of you who are not familiar with the loan to value terminology, imagine your property value is $1 million. 80% of that is 800,000. So you have a mortgage on that property for 800,000, and you want to leave that 20% buffer, especially in times that we're in now, because we're not sure whether the property values were going to go down. Thankfully, they have not, but you always want to leave that 20% buffer. So that builds in that other risk tolerance within your policy, your guidelines of lending. And then you want to look at the borrower. What kind of borrower do you want to lend to? Do you want to lend to an investor who's been doing it over and over and over and over again? And I mean a real estate investor, someone who's been buying, flipping, perhaps burring, which is buying, renovating, renting, or what's that? And refinancing. And or do you want to lend to someone who maybe in financial distress for whatever reason they need to consolidate? Typically, those are second mortgages. That brings me to the next point. Do you want to lend to a first mortgage, or do you want to lend to a second mortgage? Again, different risk tolerance for that. So we spend the 20 minutes going through how to build that policy, that internal guideline as a be the banker. You are the banker. And then we obviously talk about how much money they have. Mm-hmm. And again, I match them up with my financial advisor, Ben Jacobs, to talk about their risk analysis and whether that $200K that they're interested in lending makes sense.
Right.
And if you want to go through that risk analysis on your part, Ben, that would really be great.
Yeah, and because we're talking about the same thing, I know some people think it's different, but really, if you're doing private lending, that's just, in my view, as an advisor, that's just another asset class. So whether that's, and I look at it as, obviously it's a much more aggressive asset class, but it's very much just like investing in an investment portfolio. When I'm putting those together, I'm looking at I have the same internal policy that I go over with the client as well. The same thing, like, hey, do you want to be invested? Some people like emerging markets, for example, right? So, countries that are still growing, or do you want to be, mostly heavily US, or do you want to stay local in Canada, or do you want European? And then you can go even deeper, and this is not the point of this chat today, but just showing that there's multiple levels of factors that we can look at. And so it's the same thing, but ultimately it all starts from, like you said, that client's ability to handle fluctuations in price and risk. And so we keep saying risk, but what does that mean? Well, for anybody who's watching here, there's really three factors that go into how we look at your risk tolerance, and that's your time horizon, your long-term goals and expectations, and then your short-term risk attitudes. Right? It really falls into those three categories. And obviously I have a questionnaire, and I'm happy to share that if the audience, if they want to go through it themselves. And it gives you
that would be awesome.
Yeah, and it gives you a score, and then that kind of puts you in the brackets, and it'll kind of give you a sense of just how you feel. And this another point before I go into the actual factors, for those who have partners or doing things as a couple, whenever I sit down with a family or husband and wife or a couple of any sort, I have them fill out the questionnaire individually and separate, and so that they don't know what each other's preferences are too. And I don't know if you've done that as well, but sometimes I think couples tend to just like feed off of one another. And it's really important that everyone has their own risk tolerance, right? So, if they're not on the same page, I think that's important to identify that. But really, so when we're talking about time horizon, we're talking about their age. So when they expect to actually, and it's not just an age as in, like I said, there's not like, if you're 60, you're this. It's more about the amount of time when you're expecting to actually need this money. So when are you planning to actually require or to withdraw or need access to, like you said, that 200K that you're lending out? Well, if you're going to need it in 6 months, then maybe you shouldn't be lending it out, right? So, and it's the same thing that I tell a lot of clients too. We're like, oh, I got all this money sitting on the side, let's invest it. But then I find out, but digging deeper, that maybe that's for younger folks, that's like their down payment. I was like, well, not invest your down payment, because if that fluctuates and you need it a year from now, then that's money you shouldn't be investing, right? So it's always good to figure that out in terms of time horizon for the money, not just for the person, but it's time horizon for the particular investment, right? Because that can be different for depending on what they're investing for. And then so for your long-term goals and expectations, really ask yourself again for that particular investment, what are your particular expectations? So what's your intent with it? So is it for, you're willing to take on higher risk in exchange for potentially higher returns? Or are you more looking for stability of the principal? Like you just really don't want to lose your initial money. You just want it to grow a little bit. And then maybe some people fall somewhere in between that, right? And one question you can really ask yourself is, assuming normal market conditions, what do you expect this investment to do over time? And that's a really important question. So, there's really 4 categories. It can be like, do you generally expect it to keep pace with the stock market or real estate market? Do you expect it to slightly trail with some profit? Do you expect just stability all the time? Or do you expect a high degree of stability but expect very small profits? And then where you fall on there will kind of determine what your long-term goals and expectations are. So, and then as far as short-term attitudes, it's the same thing, same exact questions, but it's more, now what's the attitude about the next 3 years performance of this investment? And then the same thing applies. What are your expectations? Do you understand that there's a potential loss for principal that's actually realistic, or do you expect that stability, right? And then you can go even deeper. It's like, well, especially in private lending, it's like, well, not only what are your expectations for the next 3 years, because a lot of those deals, which you'll go into, I'm sure, Angie, but it's usually they're only usually 1-year deals, right? But so then it's, what's your attitude about the next 3 months performance of this investment? Because it is a real possibility that, again, depending on what your internal policy is when it comes to the properties that or the people that you're lending to, you never know what can happen, right? But that's where I think where the misunderstanding about private lending is, and that's where, Angie, you can kind of go into detail about, there's different qualities. Just like for us, there's different, a U.S. equity fund is not the same thing across the board, right? Different fund companies perform differently. They have better portfolio managers. It's the same thing just in the lending world. There's certain qualities of people that you can lend to, right?
Yeah, 100%. And, a lot of people say, oh, I'm not going to toot my own horn, and I'm going to toot my own horn. Our brokerage is known for how we qualify our borrowers and how we qualify these deals and these files that come our way. I think that's so key, is to make sure that you're aligning yourself with a mortgage broker who knows what they're doing on the private lending and is scrutinizing that deal. Like I always say, if I can sleep at nighttime, I've done my job. It's never been about the paycheck. And unfortunately, there are lenders out there who have matched themselves up with pretty shady people, and you do not want to do that. You want to make sure, again, you stick to that policy, and first and foremost, stick to a mortgage broker. Again, I'm tooting my horn. I know this area very, very well. And I make sure that the borrowers are going to be able to exit that those funds at the end of that year. And 100%, you're right, Jacob, Ben.
That's one of my names. Yeah.
It's okay. It's okay. You can call me Petty John.
Okay.
You're absolutely right, Ben. Like that exit at the end, it is 1 year. So that's a potential downside for someone who may be putting in the 200. There may be a little bit of a gap there when the next file or deal comes up. We are not qualifying everybody that comes off the street and saying, well, you have a credit score of 500, so I'm gonna match you up with Ben's 200K here. In fact, we've walked away from people like that and said, you're going to be in private lending hell forever. We don't want our lenders to be matched up with a client like yourself. Unfortunately, selling the house is the best option for you.
Right.
And just going back, there may be a gap time there when your funds until that next project comes along, right? So that's why we say diversification. That's why we say carve out some play money, if you will, right?
Yeah, and it's the same. For me, where this falls, it's the same discussion I have with a lot of clients who come to me and they want to self-direct or pick individual stocks themselves, right? The old DIY investors. Now,
right.
The first question I ask people when they say those things is, okay, well, just let's not forget about everything else right now. Just answer like the first question that comes to mind, like, what is your number one skill? Like, it could be sport, singing, whatever it is. And I would say probably 9.9 out of 10 times they don't say, stock picking and asset allocation, right? That's not their number one skill. Whereas, hey, your firm has said that they are one of the best in this area. And same thing with me. Like, I don't pick those stocks, but when I'm putting you in portfolios, I'm picking the top quartile portfolio, like, and funds in North America, right? So it's, so it's the same conversation when someone says, oh, thinking about private lending, or I want something a bit more aggressive, or pick individual stocks. I say, no problem, as long as it's not, more than 10, 15% of your portfolio overall, then no problem. And that's part of what we're talking about is diversification. I have no problems with people picking their own stocks or doing private lending. But like you said, if 200K is all you got and you want to throw all of that in a private lending deal, well, that's not going to be appropriate for you, right? And that's where it all comes down to looking at the clients and assessing their overall situation and where this kind of fits in. And for me, I feel like there's only three real ways that you can create passive residual income, which I think everybody wants. And that's one is through real estate. Two is through stock markets, whether that's like dividends and everything else that you can get from your investment portfolio. And then owning a business really is the only three ways that you can create residual income where you can, earn money while you sleep, or your money can grow while you sleep, right? And so that's, for me, that's what it all comes down to is figuring out your FIN number, so your financial independence number. That's, how much money do you need, or how much value and assets do you need to accumulate in order for all of your assets to generate enough money for you monthly that you can live off that without having to work anymore. That's it, right? And so, like with private lending deals, I know that there are some pretty aggressive deals that you've had that can create some pretty awesome income. But now that's not on a permanent basis. Obviously, like you just said, the deals expire every year, but it's part of the overall goal. So even for like myself as an example, let's say I want $5,000 a month in residual income. Like that can, if I wanted to do that purely from investments at a 4%, systematic withdrawal, I'd have to have $1.5 million in investments to accumulate that, to be able to achieve that result. Which, hey, I'll get there one day, but if you want that a little bit sooner, then you need to diversify and have other ways that you can create that income on a monthly basis. And I know that real estate, obviously, whether that's owning an income property that's cash flowing $500, $1,000 a month, or private lending, right? And then that's how I see it. It's just another way that fits into the overall picture of how we can build an income stream for our clients.
Yeah, it's very important. And that initial conversation about their goals, I find is key. Where do they want to go? Where do they want to be in 3 years, 5 years, 10, so on and so forth. So, what are your feelings about where real estate is at this very minute? Like, what are your feelings about that? Are you finding that it's a high risk right now? Because I'm hearing my investors kind of went silent for a little while, like my private lenders, because they got really nervous.
Mm-hmm. Well, and I think it's just the volatility of the markets, period, right? Is call it kind of crazy right now. And we, last week we heard from Dan Cooper and about just the lack of inventory, right? And I think that's probably why there's just, so that we've seen that. I don't know about you, but I was expecting there to be massive fluctuations in real estate prices, but everything I keep a close eye on that market, and there's been almost no change, which is crazy. But I think once things level out a little bit, I think we're going to see a little bit more stability in both the financial markets and the real estate and the housing market. And I think we'll start to see those deals come back, and all the investors will start to loosen the purse strings a little bit again too, to start new projects. But I think that's what it is everyone's just fearful still, right? We're what,
Yeah.
2-3 months into this pandemic, but the thing to remember that is that this whole crisis has nothing to do with finance. This isn't 2008, right? This is
That's
not
key.
a financial crisis. This is a health crisis. So, with even in 2008, it took, I think it was 6 months or 7 months for the 30-40% drop. And then it took another 1.5 years, 2-3 years almost to recover, right?
Mm-hmm.
So typically, from what I've seen anyways in the financial markets tend to recover 3 to 4 times it takes 3 to 4 times as long to recover as it did to drop. So that same amount of drop that we had in 2008, we pretty much had this year. And the difference is this took 3 weeks. So the recovery will be a lot quicker. So I don't know, my thoughts or feelings is just for people to have a more positive outlook. And I'm not saying we're necessarily all the way through this thing yet, but I think once things start to stabilize a little bit to a new normal, I think we'll start to see some of those deals come back up and the economy start to normalize at least a little bit.
Yeah, I'm finding right now there are a lot more borrowers coming forward, wanting to be qualified, interested in buying those properties. And my real estate investors, those that we're flipping and burring, they're coming back this way. A little nervous. Some of the ones that are burring, a little concerned that they may need to, when they're refinancing. Whole key is refinancing all the money that you've put into it, renovations.
Yeah.
So there may be. They may have to leave some of that money in their projects. So that might affect, their JV partnership, their second position mortgage, or whatever that is, and how we structured those deals. And yeah, banks are going to maybe 75% loan to value instead of the 80. So those are the ones that maybe have to maybe evaluate what they're doing or reevaluate how they're moving forward. But I'm feeling like people the confidence has been coming back. And obviously first-time buyers we always find after about 6 to 7 months when something changes, people start to come back again. That confidence is like, okay, this is our new normal. We've been hearing that a lot. Yeah. Now I'm ready. I need to know the facts, know my numbers. So so I think it's been great the last little bit. We had a report come out the other day, and everyone's uproar about it. Is the CMHC claiming 20% drops and all of this and that, and I honestly don't even know where all the numbers came from, because we haven't seen any change in property values, especially in our area. So I'm interested in seeing that. We're going to have CMHC on next week at my market update. So I'm interested to hear what they have to say. So anyhow, Ben, we're going on here for half an hour. We always chat forever, the two of us. It's always amazing. Anything else you want to say before we wrap up here?
No, other than, like we said, it's important to know your numbers, but, before we get into any specifics or any type of investment selection, it's really like we've been talking about, it's really key to sit down with, whoever advisor you're with, or in this case, it'd be both of us, right? Or someone like both of us anyways, to figure out what your actual objectives are, right? And to be really honest with yourself. And, for me, just to clarify, I'm not, we're both FSRA licensed, but this isn't my license, right? That's why, if one of my clients were to ask me about this, I'm not licensed to actually advise on this asset class, right? This is where I would, hey, if you want something a bit more aggressive, or you want something else, like your portfolio is doing great, but you want to invest in something other than stocks and bonds and all that other stuff, perfect. I would then refer to you, and I would give you the background of the client as well. So, I just wanted to clarify that, because some people might think I'll just go to Ben for some private mortgage advice. No, not necessarily. But it all comes down to what are your objectives? What's your risk tolerance? And for me personally, I would not recommend this at all to anybody that wasn't at least a growth or aggressive growth investor. So for me, there's 5 categories, and that's someone whose primary objective is income. The next one up from that is conservative growth, which would be a 50-50 split between fixed income and equities. And then moderate is something like 65-35 breakdown of equities to fixed income. And then moderate's 80-20. And then again, even within those asset classes, I would still recommend that you don't put all of your eggs in one basket, for lack of a better
Never.
term, in either with me or you. Like I'm very much a huge advocate of diversification. And so that's kind of my final thoughts.
Fantastic. Thanks, Ben. I appreciate your time.
No worries.
And are there any questions right now? We might have a question here. Oh, that's just someone saying you can ask for questions. Any questions right now from Ben, for Ben or myself? We'll just wait a couple seconds. That was great, Ben. I really appreciate it. I think integrity of who you're working with too is really key. Whether it's your financial advisor, consultant, your mortgage broker, integrity is important. Look to make sure their history and what they've done and all that fun stuff. And I know that I can always depend on you. And you think like I do. I know clients will be in good hands speaking with you.
I appreciate that, Angie. Thanks for having me on.
You're very welcome. I don't think we have any questions here anymore. So thank you everybody for coming out. And we will see you next Friday on episode number 7. Actually, today was number 7. We're going to number 8 next week. So thanks again, Ben. Appreciate everything.
Catch you next week.
All right. Bye.
Bye.